All right, let's dive in. Today we're tackling economic moats,
Oh, fascinating topic.
those competitive edges that can really make or break a business.
Absolutely.
You actually sent over some chapters from Pat Dorsey's book, The Little Book That Builds Wealth.
Oh, a classic.
Even the Chinese translation, very impressive.
Yeah, wanted to make sure we had all the angles covered.
Seems like you're really serious about understanding this stuff.
Well, Dorsey's work, I think it's considered essential reading for any serious investor,
Yeah.
and for good reason. This idea of economic moats, it's so powerful because it helps us to see beyond like the hype and the noise
Right.
and to get to what truly makes a business valuable, over the long term.
Yeah, I love that phrase, cut through the noise. It's so easy to get distracted by the latest trends or the hottest stocks, but a deep, durable moat, that's what really sets apart the companies that can consistently deliver for investors
Exactly.
from those that just fizzle out after a while.
It's the difference between I always say it's like building a castle on a foundation of solid rock or building a castle on sand.
Yeah.
Without a strong moat to protect its profits, a company is just vulnerable
Right.
to all sorts of attacks from competitors, from changing market conditions, you name it.
So let's get right into it.
Hmm.
What are some of the biggest myths or misconceptions about economic moats that we need to debunk?
Okay, well, I think one of the most common myths is this idea that, a great product automatically equals a moat.
Okay.
You might have a fantastic product, maybe something that's really innovative,
Right.
and it flies off the shelves initially, but if it can be easily copied,
Right.
if competitors can come in and create a similar product very quickly,
Yeah.
that advantage is not going to last.
That makes sense. Yeah.
It's kind of like, the difference between inventing the wheel
Mm-hmm.
and just, coming up with a slightly better wheel design.
Right. Right.
Dorsey gives a great example of this with Chrysler. And the minivan, right? When the minivan first came out, it was this revolutionary product.
Huge. Yeah.
But it wasn't long before competitors were able to catch up
Right.
and offer their own versions, and Chrysler's initial advantage just evaporated.
Yeah. So it's really about the staying power of that advantage,
Exactly.
not just having a hit product for a short period of time.
Right. It has to be something that is structurally difficult for others to replicate.
Okay. That makes sense. So a great product doesn't automatically guarantee a moat. What about brand loyalty? I mean, some companies have incredibly strong brands.
Yeah.
Would you say that alone constitutes a moat?
That's a great question. And it leads us to another very common myth, which is that brand recognition alone equals a moat.
Okay.
Now, while a strong brand can certainly be a valuable asset,
Mm-hmm.
it's not enough on its own. For a brand to truly be moat-worthy, it needs to translate into pricing power.
Meaning people are willing to pay a premium for that brand, not just for the features or functionality of the product.
Exactly.
Got it.
So think about a company like, let's say, Tiffany's, right?
Okay.
People are willing to pay a significant premium for a Tiffany diamond compared to a diamond
Yeah.
of the same quality from a lesser-known jeweler.
Yeah.
That's brand power in action.
Okay, so it's not just about being a popular brand. It's
Mhm.
about that brand actually giving you the ability to charge more for your products or services.
It's about that premium, yeah.
Okay, that's interesting. So we've seen that a great product or a popular brand on their own, they don't necessarily guarantee a moat. What other misconceptions do people often have about competitive advantage?
Well, another big one is this assumption that high market share equals a moat.
Okay.
And I think history is full of examples of companies that dominated their industries, maybe for a period of time,
Yeah.
but ultimately failed to maintain that position
Right.
because they didn't have a real structural advantage protecting their profits.
We were talking about some of those companies earlier, like
Kodak?
IBM in the early days of
Mhm.
personal computers,
Right.
Netscape, even General Motors at one point. I mean, these were companies that seemed untouchable,
They
but
seem like giants, yeah.
that dominance, it can be really fleeting.
It can be very fleeting, yeah. If you don't have a true economic moat,
Right.
competitors will find a way eventually to either chip away at your market share
Yeah.
or to completely disrupt your business model.
So even being the biggest player in the game isn't enough.
It's not a guarantee of long-term success.
Okay, what about efficiency? I hear a lot about companies focusing on operational excellence,
Yeah.
streamlining their processes, cutting costs. Surely that must be a moat, right?
Well, that's another common myth. While operational efficiency is, of course, important
Yeah.
for any business, it's not a sustainable advantage
Okay.
unless it's built on something that's unique and very difficult for competitors to replicate.
So just being good at what you do, running a tight ship, it's not enough.
It's a great starting point, but it doesn't constitute a moat in itself.
Uh-huh.
Think about it, right? If your advantage comes from, let's say, just cutting costs,
Right.
what's to stop a competitor from doing the same thing?
Right. Yeah, it's not a unique advantage.
So Dorsey, he gives us a framework, really, for thinking about what true economic moats are.
Okay.
And he identifies 4 key characteristics
Yeah.
that can create these durable, lasting advantages.
Okay, this is what I want to hear. Let's break down those 4 characteristics.
All right, let's do it.
And really understand what it takes to build a real moat.
The first category is intangible assets.
Okay.
Now, these are things like brands, which we've already touched on, but also things like patents, regulatory licenses.
Okay.
These are things that give companies an edge because they are difficult to copy.
Okay, let's dig into patents a bit more. How exactly do patents contribute to an economic moat?
Well, patents, they essentially provide legal protection for inventions.
Right.
Right. They give the patent holder a temporary monopoly on that invention, and this can be incredibly powerful, especially in industries that are driven by innovation.
So it's like saying, we own the rights to these ideas,
Yeah.
and you can't use them without our permission.
Exactly. And because they have that exclusive right to the invention,
Right.
they can charge higher prices. They can enjoy higher profit margins than competitors who don't have access to the same technology.
Makes sense. Now, the book mentions 3M as a company with a really strong patent portfolio.
Yeah, a great example.
What makes them so good at this?
Well, 3M has this incredible culture of innovation
Okay.
and a very diversified product line.
Right.
They're constantly coming up with new technologies,
Yeah.
and they're very good at patenting those innovations.
Okay.
So they've built up this wide moat around their business.
So it's not just about having one big patent. It's about that constant pipeline of new ideas.
It's about having a portfolio, yeah.
And making sure that those ideas are legally protected.
Yeah, but it's important to remember that patents are not a foolproof moat, right? They do have a limited lifespan.
Right.
They can be challenged in court.
So you can't just rest on your laurels.
No,
You have to keep innovating.
keep innovating, keep building that portfolio.
Okay, that makes sense. So let's move on to another type of intangible asset. You mentioned regulatory licenses.
Yes.
So what are we talking about here?
So these are essentially permissions granted by the government
Okay.
that can create a significant barrier to entry.
I'm thinking of things like permits for mining operations or licenses for radio and television broadcasting.
Exactly.
Is that kind of what we're talking about here?
That's exactly what we're talking about.
Okay.
Dorsey, he gives some really interesting examples, like the slot machine industry,
Okay.
where getting a license to operate those machines is incredibly difficult because of all the regulations.
So if you manage to get one of those licenses,
You're in a very exclusive club.
it's going to be tough for new competitors to break into that market.
Extremely difficult.
Okay. What other examples does he give?
He also talks about the challenges of for-profit education companies
Okay.
in terms of getting accreditation.
Right.
It's a very lengthy and rigorous process.
Yeah.
And without that accreditation,
Yeah.
they can't access federal student loans,
Right.
which makes it much, much harder to attract students.
So that creates a real winner-takes-all dynamic.
Very much so, yes.
Where, the few companies that can get through that accreditation process have a huge advantage.
Huge advantage.
This is fascinating. I never really thought about regulatory licenses as a type of moat before.
Yeah, it's a really interesting angle.
But it makes perfect sense when you think about it.
It does.
Sometimes the biggest barriers to entry are not about having the best product or technology,
Right.
but about navigating this complex web of regulation.
Absolutely. And it really highlights how important it is
Yeah,
to understand the regulatory landscape of an industry before you make any investment decisions.
absolutely, yeah. So we've talked about intangible assets like brands, patents, and now regulatory licenses. What's next?
Well, next up, we have switching costs.
Switching costs. All right, tell me more.
This is when it's either expensive or inconvenient for a customer to switch to a competitor,
Right.
even if there's, maybe a slightly better deal out there.
Okay, so we're not just talking about attracting customers, we're talking about keeping them too.
Exactly. Customer retention is key.
Okay.
Think about your own life, right? Have you ever stuck with a service, maybe a product, even though you knew there might be a better option out there?
Oh, all the time. My bank is a great example. I mean, I'm sure there are banks out there that offer slightly better interest rates, but the thought of switching all my accounts, my direct deposits, It's just too much of a hassle.
Exactly, and that's switching costs in action.
Yeah.
The inconvenience outweighs the potential benefit. Dorsey gives a good example with Intuit,
Okay.
the company behind QuickBooks and TurboTax.
Oh, yeah. I mean, everyone uses those, right?
Yeah, right. Those are pretty ubiquitous in the financial world.
Yeah.
Once you've invested the time to learn that software,
Right.
input all your financial data, starting over with a new system,
Yeah. It's daunting.
it can be incredibly daunting. And there's also the risk of messing up your taxes or your business accounting if you make a mistake during that transition.
So it's like a double whammy, the time investment and the fear of messing something up.
Exactly. And the same logic applies to, let's say, Oracle
Okay.
and their very large enterprise software systems.
Right.
Imagine you're a large company. You're running your entire operations
Yeah.
on this massive Oracle database.
Right.
Migrating all of that data to a new platform,
It's a nightmare.
it would be a logistical nightmare.
Yeah.
Incredibly costly, time-consuming,
Yeah.
and risky.
So even if there's a competitor out there with a better product,
Yeah.
maybe even a cheaper product, the effort of switching
It's too much.
is just too much.
Yeah.
It's not just about the software, it's about the whole ecosystem. It's the ecosystem, it's the integration,
Yeah. All of it.
all of that.
Okay, that's a good example. What other examples does Dorsey give of these switching costs?
He also talks about a company called Precision Cast Parts.
Okay.
They make very specialized metal components
Right.
for things like aircraft engines, power turbines,
High stakes.
very high stakes.
Yeah.
And they benefit from a slightly different type of switching cost, which is risk aversion.
I can see how that would apply in that industry.
Yeah.
You don't want to be messing around with a cheaper, unproven supplier
No.
when a faulty part could have, catastrophic consequences.
Exactly. The potential downside is huge.
Yeah.
Think about it. An airline is not going to risk grounding their entire fleet
Right.
just to save a few bucks on engine components.
Yeah.
They're going to stick with the proven supplier even if it costs a little bit more.
It's about peace of mind.
Peace of mind, minimizing risk.
Okay, so we've got inconvenience, time investment, risk aversion, all these factors contributing to switching costs. It's about making it sticky for those customers to leave.
What other examples does Dorsey mention in the book?
Well, he talks about Adobe software,
Okay.
which so many of us rely on
Right.
for creative work.
Yep. Photoshop, all those things?
Think about all those Photoshop files, Illustrator projects you've
Wow.
created.
Yeah.
Switching to a different software package
Oh, it's painful.
would mean learning a whole new system,
Yeah.
potentially losing compatibility with those files.
It's frustrating enough just trying to open an old file in a newer version of the same software,
I know, right?
let alone switching to something totally different.
Yeah, it's a pain.
What else?
He also talks about asset management companies,
Okay.
firms that manage large investment portfolios.
Right.
Switching to a new firm could disrupt those investments,
Mm-hmm.
incur significant fees.
So the stakes are high.
Very high, yeah.
And that inertia, it works in the asset manager's favor.
Absolutely.
What else? What other industries have these switching costs built in?
He talks about things like propane distribution,
Okay.
where switching suppliers, it can be a real logistical headache.
Right.
And then there are these very specialized lab equipment manufacturers like Waters,
Okay.
where the nature of their products
Yeah.
creates both, technical and training-related switching costs.
So it's amazing how many businesses benefit from these kind of subtle but powerful switching costs.
Yeah. They're often hidden in plain sight.
Yeah, it's not always something you think about right away, but once you start looking for it,
You see it everywhere.
it really makes you appreciate the importance of looking beyond just the surface
Mm-hmm.
when you're evaluating a business, right?
Yeah.
A company might not have the flashiest product.
Right.
They might not have the lowest prices.
Right.
But if they've mastered this art of creating switching costs,
They can build a very durable moat.
they can really lock in those customers.
Exactly.
All right, so we've talked about intangible assets, we've talked about switching costs. What's the next piece of the moat puzzle?
Okay, so the third category is network effects.
Network effects, all right?
And this occurs when a product or service becomes more valuable as more people use it.
I mean, the classic example is social media platforms, right?
It's a classic example, yeah.
The more people that are on the platform,
Yeah.
the more useful and appealing it becomes to
The
everyone.
more valuable it becomes, yeah.
So Dorsey actually uses the example of American Express
Oh, interesting.
in the book,
Yeah.
which, at first glance, you might not think of as a tech company or a social media platform.
Right, right.
But how does American Express benefit from these network effects?
Well, the value of American Express lies in that vast network of merchants who accept the card.
Okay.
The more places that take Amex,
Mhm.
the more useful it is for the cardholders.
Right.
Right.
So it's a self-reinforcing cycle.
Exactly.
The bigger the network, the more attractive it is to both merchants and cardholders.
To both sides of the equation, yeah.
And that makes it really tough for competitors to catch up
Very difficult, yeah.
because they have to build that network from scratch.
Exactly.
What other examples are there of these network effects?
Well, he also mentions Microsoft Windows,
Okay.
which, despite the rise of alternative operating systems, still dominates the business world.
Yeah, for sure.
And I think that's one of the reasons why so many businesses still rely on Microsoft Office,
Mm-hmm.
even though there are free alternatives available, like OpenOffice.
Yeah.
It's about compatibility, right? It's about everyone being on the same page.
It's not just the software, it's the fact that everyone else is using it.
Exactly, and that creates this powerful network effect that makes it very difficult for competitors to gain a foothold.
Even if they have a product that, on paper is just as good or even better.
Or cheaper, yeah.
Okay, so it's all about this virtuous cycle where growth feeds more growth.
Yeah, the bigger you get, the stronger you become.
Are there any cases where a company had a really strong network effect, but maybe things didn't work out so well?
Well, it's important to remember that context matters.
Okay.
Dorsey talks about eBay,
Okay.
which has obviously been very successful
Yeah, huge.
in many markets,
Right.
but they struggled in Japan and China.
Oh, that's interesting. Why do you think that was?
Well, early movers in those markets, they were able to establish their own strong networks
Okay.
that catered to those specific local preferences
Right.
and cultural nuances that eBay didn't quite grasp.
So even a company as powerful as eBay,
Yeah.
they can run into trouble if they don't adapt to those local market conditions.
Exactly, and it shows that even strong network effects can be overcome by those, localized adaptations
Evident.
and that early competition.
So you have to really understand the dynamics of the market you're operating in.
You have to know your customer.
Okay, so what's the key takeaway when it comes to network effects as a moat?
Well, Dorsey emphasizes that for a network effect to be a truly strong moat, it needs to be a relatively closed network.
Okay.
The harder it is for users to switch to a competing network,
Yeah.
the stronger that moat becomes.
The more powerful that effect is. Okay.
Right.
What other industries can we see these network effects at play?
Well, he mentions financial exchanges,
Okay.
where the more buyers and sellers you have present,
Right.
the more liquid and efficient the market becomes,
Mm-hmm.
making it more attractive.
So everyone benefits from more participation.
Exactly.
Yeah.
He also discusses Western Union's money transfer network.
Okay.
The more locations they have worldwide,
Yeah.
the easier it is for people to send and receive money,
Right.
reinforcing their dominance in that market.
Makes sense. So it's not just about these digital platforms.
Yeah.
It's about any business that can create this kind of network effect where more participants make the network more valuable for everyone.
Absolutely. And it's not a new phenomenon.
Right.
Network effects have been shaping businesses for centuries.
Right, for sure.
He even talks about freight logistics companies like Expeditors International and C.H. Robinson.
Okay.
They essentially connect shippers with transportation providers, right? Acting as matchmakers for cargo space.
Got it.
And the more shippers and carriers they have in their network,
Yeah.
the more efficient and valuable that service becomes.
It's like a giant marketplace.
Exactly.
Where everyone benefits from that increased liquidity.
Mhm.
So fascinating to see how these network effects play out in all sorts of industries, even ones that might not seem super techy at first glance.
Right. It's a very powerful concept.
All right, so we've covered intangible assets, switching costs, and network effects. What's the final piece of this moat framework?
The final one is cost advantages.
Cost advantages. Okay.
And this isn't just about cheap labor. It's about having some structural advantage
Okay.
that allows you to produce goods or services at a lower cost than your competitors, sustainably over time.
So even if your competitors know what you're doing, they can't easily replicate it.
Precisely.
Okay, I like it.
So Dorsey gives us a few good examples. One is Dell's direct-to-consumer model.
Oh yeah, Dell was a pioneer in that.
Absolutely. They were way ahead of the curve.
It seems like the standard way of doing business now, but it was pretty revolutionary at the time.
Yeah, it was a game changer.
So how did that give them a cost advantage?
Well, it allowed them to cut out the middleman
Okay.
sell their computers directly to customers, so they weren't paying those retail markups.
Right.
They weren't dealing with the complexities of that traditional distribution network.
So they could offer lower prices without sacrificing profitability
Exactly.
because their whole business model was built around efficiency.
Built around efficiency, yeah.
What other examples does Dorsey highlight?
Well, he talks about Southwest Airlines.
Okay, yeah, I love Southwest.
They've maintained a cost advantage for decades.
How do they do it? I mean, I've always admired them for their simplicity, that no-frills approach.
Right.
But how does that translate into a cost advantage?
Well, they fly only one type of aircraft, the Boeing 737,
Okay.
which simplifies maintenance,
Right.
training.
Okay.
They focus on point-to-point routes
Right.
rather than using a hub-and-spoke system like most other airlines.
So they're just incredibly streamlined and efficient in everything they do.
Absolutely, and that's allowed them to keep their costs low.
No wonder they've been so successful.
Yeah.
It's interesting how both Dell and Southwest have managed to maintain these cost advantages, even though their competitors know exactly what they're doing.
Right, it's not about having a secret formula. It's about having that system in place
Yeah.
that's difficult to replicate,
Okay.
even if the basic principles are well known.
So it seems like cost advantages often come down to process innovation and a relentless focus on efficiency.
Absolutely, and Dorsey also mentions those NMB companies we talked about earlier.
Well, yeah, the landfills, the quarries.
Their location-based advantages, those often translate into cost advantages as well.
Right, because if you're the only landfill in a certain region, you have a captive market.
You do.
You don't have to worry as much about competition driving down prices.
Yeah.
Okay, and I imagine there are cases where access to unique resources can also create a cost advantage,
Absolutely.
like a mining company that has access to a particularly rich deposit of some valuable mineral,
Yeah, they have a natural cost advantage over competitors.
who have to dig deeper or go to more remote locations.
Exactly. It's like having the prime real estate in the mining world.
Okay, so we've got process innovation, unique locations, access to rare resources. All of these can contribute to cost advantages.
Right.
But I imagine that not all cost advantages are created equal.
No, not at all.
How can we tell the difference between a fleeting cost advantage and one that's likely to last?
Well, it comes down to looking for structural advantages that are difficult to replicate.
Right.
A company might be able to temporarily lower prices by squeezing their suppliers
Right.
or by cutting corners on quality.
Right.
But that's not a sustainable approach.
So it's not just about being cheap.
Yeah.
It's about having that fundamental difference in how you operate. That allows you to consistently deliver value at a lower cost.
It's about having a system
Yeah.
that gives you a leg up on the competition.
Got it. So we've now covered all four of Dorsey's key characteristics: intangible assets, switching costs, network effects, and cost advantages.
A lot to unpack there.
That's a lot to digest, but I think the biggest takeaway for our listeners
Yeah,
is that not every advantage is a true economic moat.
absolutely.
You have to be critical and really look for those structural factors that are hard to copy.
Things that are sustainable over time
Right.
and difficult for competitors to just come in and replicate.
Yeah, it's easy to get caught up in the hype
It is.
and assume that any successful company must have a strong moat, but that's not always the case.
Think about the companies you interact with on a daily basis.
Okay.
Do any of them exhibit those signs of a strong moat?
That's a great question to consider.
Yeah, it kind of makes you look at businesses with a different lens.
It does. Understanding moats, I think, is a game changer when it comes to evaluating investments.
Oh, absolutely.
Because it helps you separate the companies with real staying power from those that are maybe just riding a temporary wave.
It's about finding those companies that can withstand the test of time
Absolutely.
and continue to generate profits for years to come.
Right, because that's what we're all looking for as investors.
Exactly.
Long-term sustainable growth.
That's the holy grail.
Exactly.
All right, so we've covered a lot of ground here today.
We have.
We've talked about Dorsey's framework for identifying economic moats.
Mm-hmm.
Those four key characteristics:
Right.
intangible assets, switching costs, network effects, and cost advantages.
Right.
And we've seen how these moats can create lasting value for businesses
Absolutely.
and for investors who know how to spot them.
So what should our listeners be thinking about as they go out and start looking for these moats in the wild?
Well, the first thing I would say is to be observant.
Okay.
Start paying attention to the businesses you interact with.
Right.
Think about why some companies seem to be more successful,
Mm-hmm.
more resilient
Yeah.
than others.
What makes them different?
Exactly.
Okay, so we're really encouraging our listeners to put on their investor hats
Absolutely.
and start looking at the world through this new lens of economic moats.
It's a powerful framework for understanding business
It is.
and for making smarter investment decisions.
Absolutely. And we'll continue this conversation in our next episode.
Yeah, we've got a lot more to cover.
We'll dive deeper into some specific examples of companies with strong moats.
All right. Looking forward to it.
And we'll talk about how to use this framework to make better investment choices.
Sound good.
So until then, thanks for joining us.
Thanks, everyone.
So we covered intangible assets.
Yeah, like brands and patents.
Regulatory licenses, all these things that are really tough to copy.
Exactly.
What's the next category of economic moat?
Next up is switching costs.
Switching costs.
This is when it's expensive or inconvenient for a customer to switch to a competitor, even if there's a slightly better deal to be had.
It's starting to seem like it's not just about attracting customers.
No.
It's about keeping them.
It's about keeping them. Exactly. Customer retention is key.
Yeah.
Think about your own life.
Yeah.
Have you ever stuck with a service, even when you knew there might be a better option out there?
Oh, all the time.
Yeah.
My bank comes to mind.
Yeah. The bank.
Yeah, I'm sure I could find a slightly better interest rate somewhere else.
Sure.
But the thought of switching all my accounts and direct deposits is just too much of a hassle.
That's switching costs in action.
Yeah.
The inconvenience factor outweighs the potential benefits.
Exactly.
The book gives the example of Intuit,
Okay.
the company behind QuickBooks and TurboTax.
Oh, yeah, those are pretty much staples in the financial world.
Ubiquitous.
Yeah.
Once you've invested the time to learn their software, you've input all your data.
Right.
Starting over with a new system, it's daunting.
Yeah, very daunting. Plus the risk of messing something up with your taxes or your business accounting.
Yeah, it's a big risk.
So it's this double whammy, right? The time investment and the fear of making a mistake.
It keeps people locked in.
Okay, and the same logic applies to these really big enterprise software systems like Oracle.
Oh, yeah. Oracle's a great example.
You've got these companies that are running their entire operations on this massive Oracle database.
Right. Mission-critical system.
To switch all that data to a new platform,
Oh, it's a nightmare.
it would be so costly and time-consuming and risky.
Incredibly risky.
So even if there's a competitor out there with a slightly better product,
Yeah.
or even a cheaper product, the effort of switching is just too high.
It's a huge barrier.
It's not just about the software itself, it's about the whole ecosystem they've built around it.
The integration, the training, the
It does.
support,
Okay.
it all adds up.
Okay, that's a great example.
Or he also highlights a company called Precision Cast Parts.
Okay.
They make these highly specialized metal components
Yep.
for things like aircraft engines and power turbines.
Wow, high stakes.
Yeah, very high stakes.
You don't want to be cutting corners there.
No, definitely not.
Say, how do they benefit from switching costs?
Well, they benefit from a slightly different type of switching cost, which is risk aversion.
Okay, explain that.
Think about it.
Yeah.
An airline is not going to risk grounding their entire fleet
Right?
just to save a few bucks on engine components.
Yeah, it's not worth it.
They're going to stick with the proven supplier, even if it costs a bit more.
They need that peace of mind.
Exactly.
They want to minimize that risk.
Absolutely.
So we've got inconvenience, we've got time investment, we've got this risk aversion.
All contributing to those switching costs.
What other examples does he give in the book?
Well, he mentions Adobe software,
Oh, yeah, Adobe.
which so many of us rely on for creative work.
Right, yeah, I'm a big Adobe user myself.
Think about all those Photoshop files, Illustrator projects,
Oh, yeah.
switching to a different software package.
Ugh, that's painful just thinking about it.
It would mean learning a whole new system
Right.
and potentially losing compatibility
Yeah, compatibility is a big issue.
with all those files.
Yeah.
He also talks about asset management companies.
Okay.
These are the firms that manage large investment portfolios.
Got it.
Switching to a new firm,
Yeah.
it could disrupt those investments, incur significant fees.
So the stakes are high.
The stakes are high.
And that inertia, it works in the asset manager's favor.
Absolutely.
It's tough to move all that money around.
Very tough.
What other industries?
He talks about things like propane distribution,
Okay.
where it can be a real logistical headache to switch suppliers.
Makes sense.
And then there are these very specialized lab equipment manufacturers like Waters,
Okay.
where the nature of their products
Yeah.
creates both, technical and training-related switching costs.
Right. So you're locked into that ecosystem.
You're locked in.
It's amazing how many businesses have these sort of subtle but powerful switching costs.
Yeah, they're everywhere.
Yeah, it's not something you always think about.
They're hidden in plain sight.
But once you start looking for it,
Uh,
you see it everywhere.
You do.
It makes you realize that you have to look beyond just the surface
Yeah,
when you're evaluating a business.
absolutely.
A company might not have the most exciting product or the lowest prices, but if they've mastered this art of creating switching
They can
costs,
build a durable moat.
yeah, they can really hold on to those customers.
Exactly.
Okay, so we've talked about intangible assets, switching costs. What's next?
All right, so the third category is network effects.
Network effects.
This occurs when a product or service becomes more valuable as more people use it.
Okay, classic example, social media, right?
Classic example, yeah.
The more people on the platform, the more useful and appealing it is.
The more valuable it becomes to everyone.
Dorsey actually uses the example of American Express in the book,
Oh, interesting.
which, you wouldn't necessarily think of as a tech company.
Right, not at first glance.
But how does Amex benefit from these network effects?
Well, the value of Amex lies in that vast network of merchants who accept the card.
Right. Okay.
The more places that take Amex,
Yeah,
the more useful it is to those cardholders.
makes sense.
So it becomes this self-reinforcing cycle.
Right.
The bigger the network, the more attractive it is to
Yeah.
both the merchants and the cardholders.
And that makes it harder for competitors to catch up, right?
Very difficult, yeah.
They've got to build that network from scratch.
It's a huge undertaking.
Okay, what are some other examples of network effects at play?
He also mentions Microsoft Windows,
Okay.
which, despite all of the alternatives,
Right.
still dominates the business world.
It really does.
And I think that's a big reason why so many businesses still rely on Microsoft Office,
Okay.
even though there are these free alternatives available.
Right, like Open Office, all those.
Exactly.
Yeah, but everybody's using Microsoft Office.
It's about compatibility.
Yeah.
It's about everyone being on the same page.
It's not just the software. It's the fact that everyone else is using it.
Exactly. And that creates a powerful network effect.
It does.
That's really hard for competitors to overcome.
Even if their product is just as good or even better.
Or cheaper. Yeah.
Okay, so it's all about this virtuous cycle, right?
Yeah.
Growth feeds more growth.
The bigger you get, the stronger you become.
But are there any cases where a company had this really strong network effect and maybe things didn't pan out?
Well, it's important to remember that context matters.
Okay.
Dorsey talks about eBay,
Okay, yeah, eBay.
which obviously has been incredibly successful in many markets.
Huge.
But they actually struggled in Japan and China.
Oh, that's interesting. I didn't know that.
Yeah.
Why do you think that was?
Well, in those markets, you had these early movers
Okay.
who were able to establish their own strong networks
Okay.
that were tailored to local preferences
That's
and cultural nuances
Right.
that eBay didn't quite grasp.
So even a company as big and powerful as eBay can stumble if they don't pay attention to those local market dynamics?
Absolutely, and it shows that even strong network effects can be overcome
Okay.
by these localized adaptations and that early competition.
So you really got to understand the market you're operating in.
Know your customer.
All right, so key takeaway here.
The key takeaway is that for a network effect to be a really strong moat, it needs to be a relatively closed network.
Okay.
The harder it is for users to switch,
Yeah.
the stronger that moat becomes.
So it's going to be hard to leave.
Exactly.
What other industries do we see this network effect in?
He mentions financial exchanges,
Okay.
where the more buyers and sellers you have,
Yeah.
the more liquid and efficient the market becomes.
Right. Yeah.
And that makes it more attractive to everyone.
So more participation benefits everyone.
Exactly.
Okay, that makes sense.
He also discusses Western Union's money transfer network.
Okay.
The more locations they have worldwide,
Yeah.
the easier it is for people to send and receive money.
So they're everywhere.
They're everywhere. Yeah.
That makes it really convenient.
And that reinforces their dominance.
Okay, so it's not just about these digital platforms.
No, not at all.
It can be these real-world networks, too,
Absolutely.
where physical presence matters.
And he even talks about these freight logistics companies
Okay.
like Expeditors International and C.H. Robinson.
Got it.
They basically connect shippers with transportation providers.
So they're like matchmakers for cargo space.
Exactly, like matchmakers.
And the more shippers and carriers they have in their network,
Yeah.
the more efficient and valuable their service becomes.
It's a giant marketplace.
Right, where everyone benefits.
Everyone benefits from that increased liquidity.
It's amazing to see network effects play out in all these different industries, even ones that don't seem super techy at first glance.
Yeah, it's a fascinating concept.
All right, so we've covered intangible assets, switching costs, network effects. What's the final category in this moat framework?
The final one is cost advantages.
Cost advantages. Okay.
And this isn't just about cheap labor. It's about having some structural advantage
Okay.
that allows you to produce goods or services at a lower cost than your competitors.
So even if your competitors know what you're doing,
Yeah.
they can't just easily replicate it.
It's not about a secret formula. It's about having a system in place.
Got it.
That's tough to copy.
Okay.
Dorsey gives some good examples. One is Dell's direct-to-consumer model.
Oh, yeah. Dell was way ahead of the curve on that one.
They were pioneers.
Yeah.
It seems so standard now,
It does, right?
but back then it was revolutionary.
So how did that give them a cost advantage?
Well, by selling directly to consumers,
Mm-hmm.
they cut out the middleman,
Okay.
no retail markups,
Right.
none of the complexities of that traditional distribution network.
So they could offer lower prices, but still maintain their profitability
Exactly.
because their whole business model was built around efficiency.
Efficiency was key.
What other examples does Dorsey give?
He talks about Southwest Airlines.
Okay, I love Southwest.
They've managed to keep their costs low.
For decades.
For decades, yeah.
I've always been impressed by their simplicity,
Mm-hmm.
that no-frills approach.
It's very effective.
But how does that translate into a cost advantage?
Well, they fly only one type of aircraft, the Boeing 737,
Okay.
which simplifies maintenance, training.
Right.
They focus on these point-to-point routes
Mm-hmm.
rather than the hub-and-spoke system.
Okay, so they're streamlined.
Very streamlined.
No wonder they can keep their fares so low.
Yeah, they're incredibly efficient.
It's interesting how both Dell and Southwest have been able to keep those cost advantages, even though their competitors know exactly what they're doing.
Right. It's not about secrecy.
Right.
It's about having that system in place that's hard to replicate.
It seems like cost advantages often come down to process innovation
Process is key.
and just a laser focus on efficiency.
Absolutely.
Dorsey also mentions the NIMBY companies again.
Ah, yes, the not my backyard companies.
Right, landfills, quarries, those kinds of businesses.
Their location-based advantages often translate into cost advantages as well.
That makes sense.
If you're the only landfill in a certain region,
Right.
you've got a captive market.
You don't have to compete as hard on price.
Exactly.
And I imagine access to unique resources can also be a cost advantage.
Absolutely.
If a mining company controls a particularly rich deposit of some valuable mineral,
Yeah, that's a huge advantage.
they've got a leg up on their competitors.
They do.
Yeah.
It's like having the prime real estate of the mining world.
So we've got process innovation, unique locations, access to rare resources.
All contributing to those cost advantages.
But I imagine not all cost advantages are created equal.
No, not at all.
Some are more durable.
Some are fleeting, some are lasting.
How can we tell the difference?
Well, it comes down to looking for those structural advantages,
Okay,
the things that are difficult to copy.
got it.
A company might be able to temporarily lower prices by squeezing their suppliers or cutting corners on quality.
Why? But that's not going to last.
That's not sustainable.
So it's not just about being cheap.
No.
It's about having that fundamental difference in how you operate.
It's about having a better system.
That lets you consistently deliver value at a lower cost.
Exactly.
So we've now covered all 4 of Dorsey's key characteristics:
We have.
intangible assets, switching costs, network effects, and cost advantages.
A lot to digest.
It is a lot, but I think the biggest takeaway for our listeners is that not every advantage is a true economic moat.
Absolutely.
You got to be critical. You got to look for those structural factors.
The things that are hard to replicate.
Right, because it's easy to get caught up in the hype.
It is. It's easy to assume that any successful company must have a strong moat.
But that's not always the case.
Not always, no. Think about the companies you interact with every day.
Yeah.
Do any of them exhibit those signs of a strong moat?
It's a great question to think about.
It is.
It makes you look at businesses with a whole new perspective.
It does.
Understanding moats, I think, is a game changer when it comes to evaluating investments.
Oh, absolutely.
It helps you separate the companies with real staying power from those that are just maybe riding a temporary wave.
It's about finding those companies that can withstand the test of time
Exactly.
and continue to generate those profits for years to come.
Right, because that's what we're all looking for as investors.
Exactly. Long-term, sustainable growth.
That's the holy grail.
That's what we're after.
It really is like having this new lens to view the business world through.
Yeah, it changes the way you see things.
You start seeing these competitive dynamics everywhere,
Mm-hmm.
and you can better understand why some companies seem to defy gravity
Yeah,
while others just struggle to stay afloat.
exactly.
But it makes me wonder, are these moats permanent?
Ah, that's the million-dollar question.
Yeah.
Unfortunately, no moat is invincible.
Okay.
The business world is constantly changing, right?
Right.
What worked yesterday might not work tomorrow.
So even if a company seems like it has this unassailable advantage today,
Mm.
that doesn't mean they can just sit back and relax.
No, they had to keep innovating. They have to adapt.
Okay, so Dorsey highlights some things that can signal that a moat might be in trouble, right?
Yeah, he talks about a few key warning signs.
Like what?
Well, one of the biggest ones is industry change.
Okay.
Sometimes the whole game changes,
Right.
and the rules that once guaranteed success, they become obsolete.
Yeah, I mean, the internet completely disrupted traditional retail, right?
Oh, absolutely.
Companies like Sears, Blockbuster, these were giants,
That's
but they just couldn't adapt to the shift to online shopping and streaming.
they're going to keep up.
Their moats, which were once so formidable, they were built on physical stores, these vast distribution networks.
Right, and those became liabilities
Yeah.
in the new world.
It's a good reminder that even the most successful companies can fall if they fail to keep up with the times.
Adapt or die.
So, what other factors can weaken a moat?
Well, another big one is disruptive innovation.
Okay.
Think about Netflix and Blockbuster.
Oh, yeah. Classic example.
Blockbuster had this massive network of video rental stores,
Right. They were everywhere.
but that advantage was completely undermined by Netflix's streaming model.
It's amazing how Netflix was able to turn Blockbuster's strength into a weakness.
Yeah, it's a classic case of disruption.
Blockbuster stores, which were once a symbol of their dominance, they became a liability
A burden. Yeah,
because consumers just wanted the convenience of streaming.
exactly. And it highlights how a new technology or new business model can completely reshape an industry
Yeah, and make existing moats obsolete.
overnight.
What else do we need to watch out for?
Dorsey also talks about changing customer preferences.
Okay.
Tastes change, right?
Right.
What's popular today might not be popular tomorrow.
I'm thinking of how, like, craft cheese lost its edge when people started realizing that, the generic brands were just as good.
Exactly.
Hmm.
Or how Coca-Cola had to adapt when demand for sugary sodas started to decline.
Yeah, people are more health conscious now.
They are. So the key takeaway here is to be vigilant.
Okay.
No moat is permanent. You have to keep an eye on it. You have to look for signs that it's eroding.
And ask yourself, is this company capable of adapting to this changing world?
That's the key question.
So it's not enough to just find a moat.
No,
You have to make sure it's holding strong.
you have to monitor it.
So what are some questions that investors should be asking themselves when they're evaluating a company's moat?
Well, first, I would say consider the industry dynamics.
Okay.
Is this an industry that's ripe for disruption?
Oh, okay.
Are there any new technologies on the horizon that could threaten the existing players?
So it's not just about looking at the company in isolation. You got to understand the bigger picture.
The competitive landscape, yeah.
Okay, what else?
Look at the company's track record.
Okay.
Have they been able to adapt to change in the past?
Right.
Are they investing in innovation? Are they staying ahead of the curve?
Or are they just resting on their laurels and assuming their past success will continue?
Yeah, complacency can be deadly in the business world.
It seems like the most durable moats, they belong to companies that are constantly evolving.
Absolutely.
We're not afraid to change.
They're embracing innovation.
What about management? Does management matter?
Oh, management is crucial.
Okay.
You want to see if they have a deep understanding of their competitive advantages.
Okay.
Are they taking steps to protect and strengthen those moats?
Or are they making decisions that could actually erode the moat over time?
You got to look for those red flags.
So you want a management team that really gets it.
They have to be stewards of that competitive advantage.
They're thinking long term.
Absolutely.
This has been a fantastic deep dive. I feel like I've learned so much.
It's a fascinating topic.
We've busted some myths. We've explored Dorsey's framework, those 4 key characteristics.
Right, those building blocks of a strong moat,
We even talked about how those moats can be eroded.
because no moat is invincible.
It's given me a whole new framework for evaluating businesses.
It's a powerful lens to view the world through.
It really is.
And I encourage you to think about those companies you encounter in your daily life.
Yeah.
Look for those signs of competitive advantage, those durable defenses that separate the winners from the also-rans.
I love that.
You might be surprised by the moats you find hiding in plain sight.
That's a great challenge for our listeners.
Yeah, go out there and do some moat hunting.
Start paying attention.
Be observant.
You might just find some hidden gems.
And if you spot a particularly impressive moat,
Yeah.
let us know.
We're always on the lookout for great business stories.
Absolutely.
Until next time, happy moat hunting.
Happy hunting, everyone.